Good morning and welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FX Pesa. So I'm happy to do this session this morning as after we had quite a violent evening last night. And by violent evening, I mean like a heavy volatility coming in from the FOMC press conference. And of course, later on, we had the Bank of Japan intervening in the currency markets, leading to a lot of volatility in Japanese yen pairs. So once you join in, kindly say hi on the live comment section. And also remember, if you have any questions, type them in the live comment section, and I'll be responding to those questions as we approach the end of the presentation. So first of all, I will begin with a disclaimer. This session is not investment advice. It's not a recommendation to trade. So always do your own analysis, your own due diligence, and practice proper risk management. So morning, Matilda, and thank you for joining. Hello, Peterson. Thank you for joining. Let's get things started. So I'll be starting with the top highlight news for the day. So I'll be sharing the Trading Economics website. And this is just a highlight of what happened yesterday. So the Federal Reserve kept the target range for the interest rates of federal funds unchanged at 5.25% to 5.50%, meaning that there was no change in interest rates in the US, and that is during its May meeting last night. So this comes amid inflationary pressures and a tight labor market, which indicate a stall in progress towards bringing inflation back towards the 2% target. So policymakers acknowledge that while inflation has moderated over the past year, it remains elevated, and there has been a notable lack of further progress towards achieving the central bank's goal in recent months. Still, the Fed Chair, Jerome Powell, stated that he does not foresee a hike as likely and believes that the current policy is sufficiently restrictive to achieve the 2% inflation target. The Fed has also declared the intention to reduce the speed of its quantitative tightening starting from June 1st, an adjustment that will involve cutting the maximum amount of Treasury securities being removed from the balance sheet by over 50%, down to $25 billion monthly from the previous $60 billion. So this is the period we've been experiencing. So as of July last year, this is when we had the last 25 basis point hike to 5.5%. So since then, the Fed has chosen to maintain interest rates at the current level. So now that we are in April, we are almost clocking 1 year, while interest rates are still at 5.5%. So this has had several impacts in the market. It was expected to bring the inflation rate down to 2%, but that has not happened yet. So if you are to look at the inflation rates, then we'll notice the progress. So just give me a second as I try to switch to US inflation rate. So as for US inflation rate, if you look at the most recent data, annual inflation rate in the US accelerated for a second straight month to 3.5% in March, the highest since September, compared to 2.2% in February and forecasts of 3.4%. So I want us to look at this chart, and if you notice that the lowest inflation rate the US has seen was lastly in June when it got to 3%. But since then, that inflation rate has never gotten below that. So the following month, it went to 3.2, then 3.7, stayed in 3.7, dropped to 3.2, 3.1, and then back to 3.4, 3.1, 3.2, and 3.5. So we are looking at around 10 months where inflation has remained above 3%. And this is proving to be such a difficult job for the Fed. And in so doing, it means that the Fed may continue holding rates higher for longer until this inflation gets down to 3.5%. So that was an important development last night. The Fed presented its case for holding interest rates at the current level. So, looking at a summary of what was discussed last night by the Fed, we will see that there were quite a number of developments which I'll be looking to share shortly. So I did an analysis of the presentation and covered a few key points that were presented. So I'll be going through each one of them, and then we see a way forward. So I did this thread on Twitter. This was when the FOMC press conference started, and some of the key highlights are as listed below. So US labor demand continues to exceed the supply of workers. And this is an important point for the Fed, basically because it has two mandates, one of them to maintain maximum employment within the US economy, and the second one is to maintain stable prices. So the job market has been pretty strong, and there's higher demand from companies looking to hire compared to the supply of workers in the market. So this is an important metric. And the Fed was afraid that during the rate hike cycles 2 years ago, it was afraid that higher interest rates would lead to higher unemployment. However, that hasn't happened, and the Fed considers this to be a win. So the Fed mandate is maximum employment and stable prices. So rates held steady at 5.25 to 5.50% in order to achieve the 2% inflation target. So inflation reports indicate that the Fed is further away from achieving inflation target, so rates may stay higher for longer. The Fed will continue the data-dependent approach meeting by meeting. So there was a couple of questions presented to the Fed Chair Jerome Powell, and here is a summary of some of the top highlights. So if inflation stays high, we are prepared to hold policy restrictive for as long as possible. So that was a comment from Fed Chair Jerome Powell. So it's unlikely that the next policy decision will be a hike. So this was a key highlight moment in the presentation last night. So the fact that he said that it's unlikely that the next policy decision will be a hike, it removes all probabilities that the Fed may continue and go for an interest rate hike. So the overall expectation in the markets now is that the next Fed decision will potentially be a rate cut. So, of course, there was a disclaimer unless we see data showing that the current policy is not restrictive enough. So the Fed chair highlighted that he sees the dangers of either going for a hike or a cut based on the current indicators in the US economy. So further rate hike would lead to a collapse in the bond markets, and this would be really bad because it would lead to collapse of several banks. So remember how many banks collapsed last year following the interest rate hikes. So continuing to increase interest rates would be very much negative for the US economy, and the Fed is not looking to do that. So on the other hand, going for a rate cut when inflation is still high, above 3%, then that would also be bad because it would lead to further inflation. So in this case, the Fed is stuck with the current level of between 5.25 and 5.50%. So on the question about rate cuts, the Fed chair has two major points. One, the only reason they would go for a rate cut is one, if there is confidence that inflation is moving sustainably towards the 2% target. And as we have seen from the inflation data, that has not been happening for the last 10 months. So the second condition is an unexpected spike in unemployment. So remember what I said earlier, and that is the Fed has two mandates, one to maintain maximum employment and the other one to maintain stable prices. So while the Fed has been holding rates higher in order to achieve the inflation target and achieve stable prices, the other mandate about jobs is as important. So in this case, if there was a significant spike in unemployment levels within the US economy, then in that case, the Fed would consider cutting interest rates in order to support jobs. So during the presentation, we had the dollar index spiking higher, gold moving higher, as well as US equity indices. And that was just within the first 16 minutes of the presentation. So Powell avoided the question about where they are easing into quantitative tightening And this was a key challenge for a lot of people who are trying to understand the FOMC presentation. So Bitcoin was up $2,500 during the meeting, and there was a question about stagflation, and Powell basically avoided the question. He didn't say accept that the US economy is in stagflation. So stagflation is an environment where inflation remains high and unemployment gets worse, while interest rates are reduced towards zero. So in this case, he mentioned that the last time the US economy was in stagflation, inflation was in double digits, and he considered that 3% would be much lower compared to the previous period of stagflation. So he said that if inflation stays at 3% or more for longer, then they don't have a plan for when to hike interest rates, but then it would be a meeting by meeting decision. So then there was a question about the impact of US elections. Remember, this year the US will have elections in November. So there was a question of whether that would affect the Fed monetary policy. So in his response, he said that this is his fourth election, and election years, apologies for that, and election years have never affected our decision making. We will not go down that road. So he's basically saying that he has been working with the Fed for at least 4 election cycles. And within that period, there is no single time that the election years have affected the Fed decisions. So on the question of other jurisdictions, let's say the Eurozone, Japan, China, and so on, going for early rate cuts since their economies are not as strong as the USA, he acknowledged that there could be central bank policy divergences this year. And by divergences, what he basically means is that in the last 3 years, what we have been seeing is major central banks collectively going in the same direction. So they have been increasing interest rates to address the high inflation that was caused by the COVID money. And now that the US economy is strong, other economies are not as strong. So you might see other central banks going for early rate cuts, which would create a divergence between the US central bank and other central banks around the world. And this is an important point to note because divergences tend to drive funds in one direction. So last point from Jerome Powell, we are happy that this rate hike cycle didn't lead to a significant increase in unemployment. So we are looking to slow down inflation to 2% without impacting the labor market strength and economic growth. And this is almost impossible. So that's one key factor to be considering today. So the next part of the presentation today is looking at some highlights in the market. So we'll start with Starbucks. So Starbucks says that there are no plans to lower prices, but Wall Street is skeptical of its 2024 plans. So Starbucks shares were down over 10% yesterday, and this was after they missed earnings. So that was a major mover yesterday, but now in the negative direction. So as you can see, Starbucks with a ticker name SBUX was down 15.88% yesterday. So the coffee giant had its worst day in trading since March 2020, with shares down nearly 16% on Wednesday after reporting Q2 results that were hard to swallow. The company missed all metrics, revenue, earnings, and same-store sales, with foot traffic declining across the globe. So now it aims to regain customers with various tactics like value offerings, menu innovation, and speedier service. But Wall Street pros tell Yahoo Finance they're skeptical that the efforts will be enough to correct costs. So we will not be taking much time on that. Just to see the other key highlight for the day. So Apple to report Q2 earnings amid iPhone slowdown, China as well as China troubles. So this will be a key market mover today. So Apple is one of the top companies in the US, and it's also part of the Magnificent Seven companies. So to report the second quarter earnings after the bell on Thursday, as Wall Street braces for what has the potential to be a sizable drop in iPhone sales out in China. So according to Counterpoint Research, iPhone sales fell 19% in the quarter. The rival Huawei continued to regain its footing after the US attempted to nick up the company by keeping it from access US chips in 2019. So the anticipated pullback in iPhone shipments follows back-to-back quarters of revenue declines out of Greater China, one of Apple's most important sales regions. So for the second quarter, revenue is set to drop by 28% year-over-year. Shares of Apple are off some 5% year-to-date and roughly flat over the last 12 months. Shares of big tech rivals like Microsoft and Google, meanwhile, are up 25% and 35% respectively year-over-year. So for the quarter, Apple is expected to report earnings per share of $1.50 on a revenue of $90.3 billion, according to analyst estimates compiled by Bloomberg. So that would equate to a 4.75% year-over-year revenue decline. So that will be a key highlight, and that will be happening after market close. So market usually closes at 11 p.m. So a majority of the activity will be in aftermarket performance. And of course, tomorrow's market open will have some volatility in Apple shares based on the actual outcome of the earnings. So I think that's it. I don't think we have any major highlights. And the next part, as part of the title of today's presentation, is about Japan's tactics to try and support the yen. So it's an explainer. What are Japan's tactics based on latest suspected yen intervention? So last night we heard the Bank of Japan intervening. Remember, they don't report this, so we can only suspect it from the price action we see on our charts. So the yen surged against the dollar on what traders suspect was another round of intervention by Japanese authorities to stem the currency's sharp declines. So while authorities have not confirmed whether they stepped in, below are some hints on Tokyo's new intervention tactics. So why did they step in? The yen fell below 160 to the dollar after the Bank of Japan, Kazuo Ueda, said on Friday the currency's recent declines and little immediate impact on prices remarks traders saw as ruling out near-term interest rate hike. Having seen the dollar yen spike the psychologically important 160 mark, Japan likely intervened on Monday to arrest the top currency diplomat Masato Kada, described as excessive volatility driven by speculative trading. So from the commitment of traders report, we saw that the hedge funds had collectively made $13 billion short position against the yen, meaning that a majority of hedge funds in the West, and by West I mean in Europe and the US, they have a net short position against the yen. And the main reason they've been speculating against the yen is because of the divergence in the two central banks. So the divergence is pretty simple. Interest rates are as high as 5.5% in the US, and interest rates in Japan are at 0.1%. So this means it's easy to borrow money from Japan and invest in the US. So having seen the Japanese currency slide over 10% against the dollar this year, then you can see that the Japanese investors and banks are basically taking advantage of this by borrowing from the economy and investing outside. So you remember what happened with the Kenya shilling about a year ago. And this is when the Kenya shilling was sliding and it went all the way up to 163 early this year. So during that period, there was a lot of loss of confidence in the value or the strength of the Kenya shilling. So a lot of investors were converting Kenya shillings to dollars. So by doing that, they are not just converting to dollars, but they are also investing those dollars either in US treasuries or in US stocks, indices, ETFs, and so on. So that's the same thing that has been happening in Japan, except that for Japan, it has been happening over a couple of decades. So with this trend continuing, it basically increases the supply of Japanese yen and reduces the demand for the dollar. Increases the demand for the dollar. And as a result, we continue seeing the Japanese yen continuing to lose against the dollar. But now the currency has weakened so much that the Bank of Japan and the Ministry of Finance in Japan feel that the weakening is now expected to affect the Japanese economy negatively, and that's why they are trying to support the currency. So the way they are doing it is by intervening, and by intervening, it means selling dollars in the market and buying excess Japanese yen from Japan's markets. So Kanda, who oversees Japan's currency policy, declined to comment on whether authorities stepped in, but said they hope to continue taking appropriate action as needed. Tokyo is suspected to have intervened again in Asian hours on Thursday, that's today, just around midnight, likely to arrest abrupt yen moves after US Federal Reserve Chair Jerome Powell's conference. So Japanese policymakers have said the weekend hurts the economy by boosting import costs, suggesting they could intervene not only to stem sharp moves, but to keep excessive yen rises from hitting households via rising living costs. So we saw it happening here in Kenya when the currency had lost to around 163. Then the cost of our imports had really gone up because we would need to spend more shillings to buy the same amount of dollars. So if the yen continues sliding, they're also facing the same problem of expensive imports. And in order to stop these and stabilize prices, that's why the Bank of Japan, working with the Ministry of Finance, have been working to strengthen their currency. So that's the key highlights for the day. And now I think we can jump to the favorite topic. And this is talking about market analysis. So we'll do some technical analysis and try to understand where the markets might be headed next. So today's session might be a little bit longer than usual. So hello, J Squad. Thank you for joining. I can see Samuel Minor, Hari Luteshi. Thank you for joining. Hello, Aridi, Paul Carrier, Robert, Manthi, and Alamik Buire. So I've seen there is a couple of questions, so I'll be addressing the questions towards the end of the presentation. What's your take on Apple? That's a good question. So I'll be addressing that as we approach the end of this presentation. We have a new member who has joined the class under the username Adventure13. Thank you and welcome to this session. Remember, these sessions happen every day, Monday to Friday from exactly 11 a.m. So just subscribe to the channel so that whenever we have a live session, you will get a direct notification. So now that we are done with that, let's try and look at the charts, a couple of them before we end the session. So of course, the key highlight for the day, we already mentioned, is FOMC press conference, and of course, what happened with the dollar after the FOMC press conference. So this is a chart of the dollar index, having traded within this channel for about 3 weeks. Then it made a breakout towards the upper side on Wednesday, and then yesterday during the FOMC press conference, there was a major sell-off. So the news were not in support of a weaker dollar. In fact, the news were in support of a strong dollar because what Jerome Powell basically said is that rates will stay higher for longer, which is positive for the dollar. So the main reason we saw the dollar index being sold was because the market had already priced in the move. So if you look at Wednesday, before the Fed press conference, a lot of investors were betting on a strong dollar, and that's why we had this rally. So after the news were confirmed, we had the market doing the exact opposite. So sometimes it's called buying the rumor and selling the news, and this was a perfect opportunity for investors to do that. However, following the events of last night, now you can see that markets are beginning now to price in the potential of what Jerome Powell said, and today it's more likely that we will be seeing the dollar index start making a recovery. So as for the USD-yen, you can see that after the intervention on Monday, the market has spent the better part of the week making a recovery against this intervention. So remember, I mentioned that there is a $13 billion short position against the yen. So that led to the market reversing the activities of the Bank of Japan. So they kept creeping higher and higher. And then after the Jerome Powell meeting last night, we heard the Bank of Japan intervened, and there was a big surprise movement happening last night. So kindly note that the move is bigger than the one we had Monday. So on Monday, from a price level of around 160, we had the currency correcting 3.51%. So I don't know if it's very big. So this movement last night was about 3.14%. So almost the same. So in this case, after the intervention, you can see this big spike downwards was met with more buying pressure, similar to what happened on Monday. So after this big move here, you'll notice that immediately buyers came in and pushed the prices back up the following day. So a similar thing is happening here. So after the big drop, you can notice how the markets jumped immediately. So meaning that there is a very strong battle between investors, speculators, hedge funds, and the Bank of Japan. So often you'll notice that the Bank of Japan always wins. So anytime I've ever seen an intervention, it has been a similar battle, and eventually the Bank of Japan wins. So when it happened a few years ago, and this is 2022, you'll notice that the first day there was a big spike up, and then the market dropped. Following day, market moved higher, then down. Every time it moved higher, the Bank of Japan would intervene until it absorbed all the demand, and the prices eventually started to flow downwards. So when a central bank commits to support its currency, it cannot accept to lose against speculators. So they will do everything in their power to make sure that the Bank of Japan, that the Japanese yen doesn't slide back to 160. So any opportunity they get, especially after these rallies, they will continue pushing prices lower. So it doesn't make sense to be speculating against the Bank of Japan. So every time there's a rally, you should be looking for potential short selling opportunities. And I think that will be a key theme going forward for USD JPY traders. So after the big drop and then you can see as we enter the London session, there's a good chance that the market keeps dropping further downwards as investors lose confidence in bullish positions, knowing that the Bank of Japan can intervene at any given time. So Euro USD was pretty strong last night, and this was the price action during the Jerome Powell's presentation. But as we have mentioned earlier on the presentation, that now the market is processing the news, and now we're expecting that the dollar will start recovering because Jerome Powell's comments basically implied that the rates will stay higher for longer, which is positive for the dollar. So in this case, we expect a recovery, a full recovery was the start of the meeting. So at least a target of 1.6738. So for pound USD, it's the same thing. So there was a net gain during the presentation, but now we are looking at a potential drop. Of course, we have a key level support here, and this is the lowest price we saw yesterday. So in this case, I expect to see the pound weakening to the dollar and the price dropping to 1.24673. So for New Zealand USD, there was a strong rally, but now we have met a major resistance area. So perhaps we should be looking to retest yesterday's low. So expect the price to change direction and move downwards. So now we are looking at a potential book candlestick pattern. So more of a bearish engulfing with a shooting star. So in this case, potential for the market reversing at this point is quite significant. So USD trading against the Swiss franc, there was a major sell-off after we had a breakout here on Tuesday and a rally extended on Wednesday before we had some losses. And then there was this big spike downwards, but eventually as the dollar strengthens, we could potentially see the market retesting this area here. So as for USD CAD, we can see that the dollar was on a net loss against the Canadian dollar, but now the market seems to be finding support around this area. And as the dollar regains strength, there's a good chance we could be seeing the market now bouncing from around this area. So as for gold, there was a net gain. This was a big spike to 23.24, and that was during the FOMC press conference. But as the markets have opened today, the better part of the Asian session has been gold erasing yesterday's gains. And this bearish momentum is expected to continue. So potentially, we could see the market drop to 22.91 for the day. So it's an easy intraday trade, especially for the gold traders in the house. So US equity indices managed to erase the gains immediately, so they were not affected much. So if you look at the Dow Jones, they made a big spike during the FOMC press conference, but then within the next hour just came back to the same point. So the current prevailing fundamentals keep driving the markets, especially the earnings, but then the impact of the FOMC press conference was just high volatility, but prices remained the same. So in this case, we'll be looking forward to more earnings from various companies to see the potential direction of the Dow Jones as well as the Nasdaq and the S&P 500. So looking at big tech, if Apple misses earnings tonight, then there is a good chance that the S-Tech 100 continues dropping. And of course, the S&P 500 could also be affected by Apple's earnings. So that will be on forecast today. Then we have Brent oil, which has been largely on a bearish momentum. So after managing to find some support here, it broke the level. I found another support here of the level. So it has been breaking multiple levels further downwards as US inventories continue to increase. So now we are seeing a key level test of another major level here. So if you look at this area here, and you look at past prices, then you will notice that it was quite significant. The number of times that the market had found resistance here and now turned into a support, makes it more likely that Brent will be bouncing from this price level. So from the most recent price action, we have seen the market trying to make a build up of bullish momentum, and we could be seeing some further upside potential running from this bottom here. So Bitcoin made a big spike yesterday during the FOMC press conference, and then similar to stocks, erased all those gains within the same period, and then closed at this area here, slightly higher than at the beginning of the FOMC press conference. So later on, we've seen Bitcoin continue to trade sideways since last night. So in this case, I would say that Bitcoin is currently in a consolidation zone. And within this consolidation zone, we can see that there will be a potential for a breakout. So be on the lookout for a potential breakout in Bitcoin prices. So also remember that yesterday is when we had the Asian spot Bitcoin ETFs beginning to trade, and they didn't have the expected volume, but then we could be seeing the volume beginning to build up. The first trading day was on the 30th of April. So yesterday was the 2nd. So today we'll be looking at the 3rd day of trading. So European equity indices are currently on a bear market. I remember we discussed this and mentioned after failing to form higher highs, we expect the price to drop to this area here. So targets have been hit. So now we observe the price action around this area to see whether there will be a bounce or a break in order to generate the next trading idea. So in this case, we are still on the target area. So looking at potentially the market bouncing, which would imply going long, and breaking would imply we go short. So right now it's a key decision point. So we observe the price action to see the direction. So the French 40 index managed to drop similar way, got to the target, then it didn't stop there. So it has extended further downwards for the day, which implies that it's likely the price will continue weakening. So in this case, with further bearish momentum, perhaps we should be watching this trend line now to see if the market eventually gets to the trend line, and the potential could be around this area here, around the price level of 78.60. So this is something we should be watching for over the next 1 week. So we could be seeing the stock market extending the losses and dropping further down to around 78.16. So the dollar trading against the Chinese yuan, there was a big spike downwards as the dollar was losing. We also had a big spike last night, but now in the last 1 hour, there was this huge drop, which has been met with extreme resistance, or extreme support. And now we are seeing the market erasing all those losses of the previous 3 hours. And now it seems more likely that the dollar against the Chinese yuan will be making a recovery. So it seems more likely that we will be seeing more upside later in the day. So the Hong Kong 50 index, this is something we had discussed. We talked about this pullback and identified that this is a likely area to be looking for bullish positioning. And now this morning, the market opened with a very strong rally, and I expect this rally to be extended for the day. So that's the Hong Kong. The China A50 index is also doing the same thing. So after the bearish momentum here, we saw the market facing a very strong rejection. So after the rejection here, you'll notice that the market kept trading sideways. And then today at market open, made a big jump higher. And now for the day, for the rest of the day, I expect some further upside momentum. So that's it for the day. So now I will check on the questions. And once we answer the questions, we end the session. Hopefully everyone will have a happy trading day. So let's begin with the first question from Lamek Buire. Why does the dollar weakens during FOMC meeting and interest rate decision, yet we all expected rates to remain the same and the dollar should be strong? Instead, it weakened yesterday. So this is a really good question. I think I've already answered it. Whenever there is a very strong conviction in the market that some certain news will come in this direction, markets will tend to price that in. So in that case, you'll find that there will be a scenario of buy the rumor, sell the news. So if a majority of the investors or participants in the market expect that the Fed will continue holding rates higher for longer, then they'll be buying the dollar before the FOMC press conference. And once the FOMC press conference confirms the news, then they'll be selling rather than buying. And in that case, you find that the dollar is reacting negatively. So next question is from Joseph. So what is your take on Apple? So my take on Apple is pretty simple. They've been taking a big hit from China. And by hit, I mean one of the key developments was that Chinese government workers were banned from using Apple devices at work. Then after the US had blocked Huawei from deploying its devices in the US and also blocked their access to top microchips from US companies, they went ahead and developed their own 6-nanometer microchips, which became a big impact in China, and Huawei is picking up the Chinese territory. So with that, Apple sales have really gone down, and we are looking to see the outcome later in the day. So in this case, there will be a pretty big expectation that Apple earnings miss later this afternoon. So of course, we have the non-farm payrolls later in the day. So non-farm payrolls are expected to bring in some volatility. Of course, just a second. So for the non-farm payrolls, just trying to load my chart here. So the non-farm employment change is expected at 238K, down from 303K in the previous reading. So the thing is, the labor market is pretty strong with the US, as Jerome Powell mentioned yesterday. So a strong labor market is expected to be consistent with the Fed's expectations. So as a result, we expect to see the dollar regaining strength. So if the number is higher than expected, then we should be expecting to see the dollar make an impressive recovery later this afternoon. So looking at the next question. Kindly request don't miss the evening class. We cancelled the Thursday evening class, so that has been effective for a while now. So unless something changes, we will not be doing it. So hopefully, I've done an extended session today that covers a majority of the talking points in the market. So HK50, it means that there is a likely movement up or to the upper side. So I'll be sharing the chart, and I think I've already done this. So the HK50, just go to your daily chart and then look at the yearly trend line. So this is something I'll be sharing with you. So from this moment here, this was the 26th of January 2023, and this market was on a complete bear market on this channel. And then recently we had a breakout. This breakout has led to a very strong rally, So we had a pullback and a continuation. So I think it's a pretty easy trade for you. So we have had this is 6 consecutive days on a rally, a 1-day pullback, and then today there has been a very strong momentum upwards. So it's a key trend to watch, and it's an easy trade because it's a breakout and the market is just recovering from a bear market. So there's still very strong upside potential. So thank you very much, guys, and I hope to see you on the next session.